Good evening and welcome to our 2025 second quarter financial market update call at Great Lakes Private Wealth. This is Dan Murphy, founder and chief investment officer of Great Lakes Private Wealth. I've titled tonight's call is The Smoke Clearing. The call tonight's being recorded and will be on our website, greatlakesprivatewealth.com, shortly afterwards. Now let's get into what happened in the market in the second quarter and what we're going to see going forward. Pat Patin will give us some data, and then I'll update you on my outlook on the markets.
Thank you, Dan. This is Pat Patin, partner and portfolio manager of Great Lakes Private Wealth. Before I get started, I must remind everyone that past performance is no guarantee of future results, and all the information we'll be providing is from sources we believe to be reliable, but there's no assurance that the information is accurate or complete. This presentation is for informational purposes only and is not an offer, recommendation, or a solicitation to purchase or sell any security or to employ a specific investment strategy. It's not designed for, individually tailored to, any particular investor and is not intended to be suitable or in the best interest of all types of investors. Opinions expressed in this presentation are subject to change without notice, and there is no guarantee that any forecast made will be realized. And with that, I'd like to start off some key stats for our call. As of this afternoon, the year-to-date price return of the S&P 500 is up 8.3%. The Dow Jones Industrial Average is up 4.9%. The Russell 2000 Small Cap Index is up 0.5%. The NASDAQ Tech Composite is up 9.3%. International stocks, represented by the EFA Index, are up 17.9%. Gold is up 26.5%, and bonds represented by the Bloomberg Aggregate Bond Index, the total return is up 3.4%. So today I wanted to frame the environment that we're operating in because it's critical to understand the dynamics that caused the decline we saw in March and April, and then the subsequent rally we've seen over the last few months in the stock market. And as Dan mentioned, we're titling it, Is the Smoke Clearing? And we seen that some of the smoke seems to be clearing, and we may be on the other side and seeing some resilience. Despite this noise of inflation pressures, tariff concerns, unpredictable policy swings, our clients have done generally quite well, particularly on a risk-adjusted basis. We've stayed disciplined and diversified. And now with markets at or very near all-time highs, it's a little like fishing in a lake that's been overfished. All the easy catches seem to be gone. So instead, we've been looking to be fishing in different ponds, looking for opportunities outside of the traditional areas where most investors are crowding into. That doesn't mean taking reckless bets. It means being selective, thoughtful, forward-thinking, especially when valuations are stretched and risks are a little more concentrated than they were. One example that we've gotten some questions on is our inclusion of the spot Bitcoin ETF in select aggressive strategies that we run. And I'd like to take a step back and talk a little bit about what Bitcoin actually is, not just as an investment, but as a technology. So Bitcoin was created in 2009 as a peer-to-peer electronic cash system. It runs on a decentralized public ledger called the blockchain. And I'm not going to go into extreme detail here, as we could be here all night, but I really wanted to tell you the blockchain records, all the transactions transparently and securely, and it doesn't have a central authority like a bank. What makes Bitcoin truly unique is its fixed supply. There's only 21 million coins that will or should ever exist, and that scarcity combined with decentralized governance makes it an appealing potential digital store of value, I'd say similar in spirit to gold, but native to the internet. Now, Bitcoin has grown from an idea into what I would say is a globally recognized asset now. Today, it's owned by individuals, institutions, pension funds, and increasingly used as a hedge against currency devaluation, geopolitical risk, and central bank or monetary policy uncertainty. And until recently, access to Bitcoin was pretty clunky. You required crypto wallets and exchanges that you could screw up or send things accidentally, but that has changed in a big way now. In early 2024, the SEC approved the first spot Bitcoin ETF, and that was making Bitcoin easier to invest through traditional custodians like Fidelity, Schwab, and others. And this brought regulated, insured, and institutionally backed exposure, to retail and advisory clients alike. And we may see Bitcoin even available in 401k and retirement plans, opening up a new wave of accessibility as regulatory environments continue to evolve. And there's also progress on a policy front. You may have heard the new bill that's out there, nicknamed the Genius Act. I think it's officially called the Financial Innovation and Technology for the 21st Century Act, or the FIT 21, but many call it the Genius Act, and that's making its way through Congress right now. And this legislation would give digital assets like Bitcoin a formal regulatory framework. It would give jurisdiction between who has control between the SEC, the CFTC, some investor protections, regulating stable coins, a piece of the infrastructure and cryptocurrency, and it would encourage innovation to stay within the U.S. rather than going offshore. And for investors, this kind of regulatory clarity is a good thing. It reduces uncertainty, invites institutional capital, and it opens the door to broader adoption, as I mentioned, retirement accounts. So in short, it helps solidify Bitcoin's legitimacy as an investable asset. Now, historically, Bitcoin has been very volatile, and we acknowledge that, but the story is evolving. This chart from Charlie Bilello, if you're following along on our webinar here, shows that this year in April, the 12-month volatility has really come down over the years, and in fact, it dipped below that of the S&P 500. So it was actually less volatile over the last 12 months than the stock market. It was a pretty rare moment that reflects that it's becoming a mature asset here. And there's an even broader view, I have between CoinShares and Bloomberg, if you're still following along, and it shows the 30-day volatility for Bitcoin, comparing it to the S&P and the NASDAQ, and it's dropped significantly over the last 7 years here to pretty similar to that of the NASDAQ now. So as I mentioned, a little more mature asset class that's being adopted. And in fact, according to Fidelity, by the end of 2023, Bitcoin was actually less volatile than 92 stocks of the S&P 500. So again, that doesn't mean Bitcoin is suddenly some low-risk investment, but it may no longer be the outlier we thought it was years ago. So for us, Bitcoin, it's not going to be a core holding by any means. It's a tactical, diversifying asset, and we're only going to be using it in portfolios with a higher risk tolerance, and we'll size it conservatively, often under 5%. But it's one of the ways we're looking for uncorrelated opportunities, lopsided upside in a market that has gotten narrower and narrower at the top here. So it's a perfect example of how we're thinking differently, not just following the crowd, looking ahead, with some discipline and some creativity here. And before I hand it over to Dan, I wanted to leave you with just another broader historical perspective as we're talking of asset classes and innovation, one we think is especially relevant in today's market environment. Many of you will remember the dot-com boom of the late 1990s. That excitement was palpable, to say the least. It was new technologies, explosive gains, market concentration in just a handful of names. Sounds pretty familiar to what we're dealing with today. And on the webinar, you may be able to see it's a recent chart from Bespoke Investment Group that caught our attention. And it compares the NASDAQ's performance following the launch of Netscape, the browser, in 1994, and showing the trajectory since the launch of ChatGPT in late 2022. And what's remarkable is how closely they align. Over the last 664 trading days, the NASDAQ is about 92% higher after ChatGPT, and it's about 120% higher from the NASDAQ Netscape era, and that's about a 0.94% correlation, so very, very high correlation of what we've seen. And if we track where we are now following the birth of AI and where we were in the 90s, at this point following the launch in Navigator Netscape in 94, our comparable time frame would be August of 1997. So the chart shows that the stock market certainly climbed a long way between mid-1997 until the ultimate peak in early 2000. So you almost had 3 more years of a gain here. But what often gets lost in the story of the dot-com bubble is the narrowness of the rally, as the tech-heavy NASDAQ was up 140% in the year before March of 2000. but most stocks were actually flat or down. In fact, the top performing decile of stocks rose 440%, but then lost half their gains the following year. So underperformers before this peak, the non-tech names and other asset classes, rewarded investors handsomely after that bubble burst. So the parallels to today are pretty striking. AI and ChatGPT have sparked this ecstatic investor interest, much like Netscape did. And just as Netscape launched the internet phase and eventually gave way to winners like Google and Amazon, history shows that broad speculation, it doesn't last forever, right? So in both cases, investors chased revolutionary technologies, the internet then, artificial intelligence now. And while longer-term innovation often leads to transformative change, this market euphoria can also lead to some short-term excess. And we're not saying a crash is imminent by any means, and we are saying that the breadth of the current rally is narrowing and investor sentiment is heating up, and that's why we'll remain vigilant, right? We're looking for opportunities that are underappreciated, not overcrowded, and we're maintaining balance so we're not overexposed to any one narrative. And if this is 1997 again, we may have more room to run, but if it's early 2000, we want to make sure we're not positioned just for momentum, but for some durability as well. So in this environment, our approach remains grounded here, where innovation drives powerful gains. The risk of a narrow cyclical blow-off is a possibility. And our mission hasn't changed. Protect, grow your wealth, not just by following the markets here, but by staying in front of them. And that means staying informed, staying flexible, and sometimes fishing in these new ponds where the old ones were crowded. And with that context in mind, and our radar up for signs of euphoria, let me turn it over to Dan, who will expand on the theme of tonight's call.
Thank you, Pat. Let me start with a brief summary of what I shared on our last call in April of this year. If you remember, I titled our last quarterly call, Uncertainty Everywhere. In April, we were dealing with so-called Liberation Day with the announcement of tariffs on almost every country. Instead of the 10% tariffs as expected, President Trump threw everyone a curveball by announcing tariffs would range anywhere from 15% to as high as 69%. This led to an extreme sell-off in the stock market. In fact, it was the fastest 20+% sell-off in market history. That's saying something. Now we've seen one of the fastest recoveries. Tonight's call is titled, Is the Smoke Clearing? I think this is a good analogy of how the facts or data, so to speak, are changing. And we're getting some clarity on several key issues the market's been grappling with since early April. Tariffs, interest rates, the big, beautiful bill, as I say tongue-in-cheek, and how inflation is going to act if the tariffs are enacted, and how would all of these different factors affect corporate earnings, which in turn affects the level of the stock market. Tonight, I will discuss the areas where the smoke is cleared up and the areas where we are still lacking clarity. As any good fireman knows, until all the fires are out, we cannot give the all clear. But as we get more and more clarity, we can start to get more constructive on putting money to work and adding money to the stock market. One area where we've gotten some very good clarity is the new tax bill. This is the bill that made the 2017 tax cuts permanent and added some major components to help the economy going forward. First, the 2017 tax cuts have been made more permanent. Having this bill become law and will allow corporations and individuals the ability to plan for the future. There are a couple of provisions that are extremely positive for corporate America. Most importantly is the ability of corporations to deduct 100% of the cost of new plants and equipment as it relates to investing in their businesses. This is a huge incentive for corporate America because if they invest $1 million in a new machine or plant, they can deduct 100% of the cost from their tax return in this year. Prior to this, companies could not only deduct the cost of the new plants and equipment only over a 10 or 15 year period, or maybe even longer. So if a company does invest $1 million, they can deduct $1 million from their tax return versus only deducting $100,000 a year for 10 years. This means the company saves taxes on the whole $1 million this year instead of only saving a small portion of taxes over a 10 to 15-year period. This is a huge incentive to invest in new plants and equipment. So you will see companies buying new equipment, investing in new plants, because now they can deduct it all in 1 year. In prior years, they were hesitant in making such large capital investments. The other big plus is the corporate tax rate of 21% for corporations was made permanent. This is another positive for companies because they now know what their tax rate will be. This is extremely important to companies when they are planning out budgets and investment timelines. This one part of the new tax bill should have positive implications for the stock market for at least the next several years. So this is some huge clarity we have received versus just 3 months ago. One area where we still do not have as much clarity as I would like to see is in the area of tariffs. This is taking a little longer than the markets would like. So on Sunday, the U.S. made an agreement with the European Union to have 15% tariffs. A week before, we got a deal on tariffs between Japan and the U.S. We're still waiting on Mexico and Canada, which are a couple of our largest trading partners, and we have nothing yet out of China. We've been told they are working on a deal. So I would rate this as the smoke is clearing. Based on the administration's past history, there appears to be a good chance of getting these additional deals. Once the deals are finalized, then we can make some determination as to what the real impact on the U.S. economy and corporate profits will be. It will take some time to see exactly what the impact the tariffs will have on inflation. So from a clarity standpoint, I rate this situation as improving, but we still have some, so to speak, smoldering fires going on that need to be extinguished. If anyone has traveled to northern Michigan like I have recently, there are literally days when the sky is clear, and then there are days when you would think the fog has moved in. In reality, it's not fog, but smoke from over 1,500 fires burning in northern Canada. Or on any given day, depending on how the wind is blowing, it can make it appear that you're in one of the worst fogs you've ever seen. Yet again, it's not fog, but smoke from fires over 500 to 1,000 miles away. As these different trade deals are signed, we'll have to wait to assess their final outcome and impact on the economy and any residual effects, some of which are predictable and clearly some are not. The real question as it relates to tariffs is the impact on inflation. If you remember in April, one of the biggest concerns from the investing community was what was the impact tariffs would have on inflation. In April, I quoted a chief investment officer of a company who said, in 30 to 60 days, we should expect shortages of goods on our shelves. Well, guess what? That did not happen. This is a perfect example of why you must protect yourself from listening to all the talking heads on TV. In fact, so far, all the tariff talk has not had much impact on inflation at all. In April, the CPI was up 2.3%. In May, inflation was up 2.4%, and in June, the reported number was 2.7%. So the impact so far has actually been quite small. There are a couple of hypotheses to explain this. The first explanation is that many companies and individuals bought goods ahead of the potential price increases due to tariffs to avoid these increases, and this is why they've not appeared in consumer prices yet. The second explanation is that whatever price increases do occur, part of the price increase will be passed on to the consumer, and part of the increase will be absorbed by the corporations. The third explanation is the economy has slowed and prices for many goods have eased slightly. These lower prices due to lower consumer demand is being offset by what companies have raised the price to offset the tariff increases. We really are not sure yet if this is true or not. So as I just said, as trade deals, tariffs get finalized, we'll analyze corporate behavior and pricing, and more importantly, how does the consumer respond to these changing prices? As the economy slows ever so slightly, if a company raises prices due to tariffs, they must be very careful not to upset the consumer because in most cases, the consumer has many choices. And if they see price rise too much, they will end up making other choices with their purchasing dollars. This is another explanation for why prices are not rising as fast as many economists had expected when tariffs were announced in early April, as companies are fearful of losing their existing customers. As I mentioned earlier, the one area where we're still waiting for more clarity is interest rates. Even with the economy slowing down, the Federal Reserve, which controls interest rates, has been hesitant to lower rates. The primary reason for their hesitancy is that they are waiting to see what the true impact of tariffs will have on inflation. I want to remind everyone of the two key things the Fed's responsible for. First is maintaining stable prices, or said in English, keeping inflation around 2 to 2.25%. The second responsibility of the Federal Reserve is to make sure we have stable employment. Earlier, I stated CPI for May was 2.4 and June was 2.7. So this is slightly higher than the Federal Reserve's mandate of 2 to 2.25%. The Federal Reserve feels the potential impact has not been felt yet, and if they were to lower rates now, and they do start to see inflation arrive due to the tariffs, they would be forced to raise rates to slow this inflation back down again. They don't want to make this mistake and end up with egg on their faces, so to speak. So as a collective body, they've decided to wait for clarity on the impact of tariffs on inflation. The real risk, as far as I'm concerned, is they wait too long and we start to get a real slowdown in the U.S. and world economy. There's an old saying that once the train leaves the tracks or the horses get out of the barn, it's hard to get them back in the barn or get the train back on the track. The Federal Reserve is meeting this week, and they usually signal to the markets their intention to either lower rates or leave them as is. The betting markets are saying the Fed is going to leave rates as is this week. Unfortunately, after the inflation of a couple of years ago, they're just too worried to make a mistake. Rates have hardly moved, though, in the last 3 months. On April 21st, the 10-year Treasury yield was 4.4%. Today, the 10-year yield is at 4.42%. That's about as close as you can get to unchanged over a 3-month period as possible. This is why many participants, including the president, are pushing for lower rates. The Federal Reserve will report tomorrow, July 30th, if they've decided to keep rates the same or will they start the process of lowering them. They keep saying they're watching the data. The data says the economy is slowing, job growth is slowing, and the housing market is the weakest it's been since COVID. Yet the Federal Reserve has continued to keep rates elevated. If you've been watching the news, you've seen that President Trump is very annoyed with Chairman of the Federal Reserve for not lowering rates already. There have been rumors that he was going to fire the chairman. I believe as many that would be a big mistake because one of the key tenets of the Federal Reserve is that they are not political and are independent of politics. President Trump has denied he will fire Chairman Powell. In May of next year, Chairman Powell's term ends as chairman, and there is no doubt he will be replaced with a person that President Trump considers more dovish or someone who will be more agreeable to lowering rates. A new Federal Reserve chairman next year, along with lower interest rates, would be very beneficial to President Trump and the Republican Party going into the midterm elections. There is a very high probability that Chairman Powell will be replaced next year in May. Lower interest rates are beneficial to so many parts of the economy, especially housing, small businesses that use credit to help their businesses expand. The other major effect of rates is on the very large national debt of the U.S. government. The level of interest rates is critical to the health and potential growth of the U.S. economy. I believe that interest rates will stay fairly stable in the short run until we have more clarity on the impact of tariffs on inflation. Unless or until we get more data telling us that a more substantial slowdown in economic activity is coming, interest rates will stay about where they are currently. Businesses have adjusted pretty well to the level of current rates. The one area that has not totally adjusted yet, though, is the housing market. Housing has softened quite a bit, and the inventory of homes on the market and the number of days they are listed before selling has steadily increased over the last year and a half. Housing is 16 to 18% of the economy as measured by GDP, so it is a very important and very sensitive to interest rates. This coming Friday, we will get the unemployment report, and a week or so later, the next inflation report. If we look at unemployment in June, the number of jobs created was 147,000. The unemployment rate last month was 4.1%. This was the lowest number of jobs created this year. It certainly is trending in the wrong direction. The Federal Reserve's two key mandates, inflation and unemployment, certainly are at levels where the Federal Reserve could act to lower rates if they were not so focused on the potential for inflation from tariffs. This Friday, we get another unemployment report from the Labor Department. And this will give us a little bit more indication on how well employment's holding up and how is the economy doing. In summary, the Federal Reserve is very cautious to make a mistake again by lowering rates too quickly and allowing inflation to take off again. We will know more tomorrow at 2 p.m. when we hear from the Fed, and Friday at 8:30 a.m. when we get the most recent unemployment report. Now let's review investor sentiment and a couple of other key indicators. Before I do, I want to talk about the weakness in the U.S. dollar. The U.S. dollar is the most used currency in the world to transact goods between buyers and sellers. This year, the U.S. dollar has fallen almost 6.7%. That means on average, it's costing Americans 6.7% more to buy goods from foreign countries. Remember, this excludes any effect of the tariffs. If you've traveled abroad recently, you'll know this to be true. On December 31st of last year, it took 104 euros to buy $1 US. Today, it takes 116 euros to buy the same dollar. That means it costs about 11% more to travel in Europe than it did a year ago. When the dollar is weak, it causes U.S. citizens to pay more for everything they buy from overseas. This is one of the biggest drops in the dollars in many years and needs to be watched closely. It affects travel and commerce between countries and, more important, corporate profits in a very meaningful way, and it usually is not in a positive way. In fact, we're just starting to hear from companies as they report their quarterly earnings that earnings would have been better if the dollar had not been so weak. Since the U.S. consumer is so important to world economic activity, this will need to be monitored closely. If you're traveling overseas, be prepared to pay more for everything. It actually ends up being a form of inflation on U.S. citizens and deflation or a benefit to foreign citizens. As I do on most of our calls, I like to discuss investor sentiment. Pat's put up the CNN Fear and Greed chart. Clients have been with us for a long time, know how much credence we put into investor sentiment. In April, with all the talk of tariffs and its potential negative effects on inflation and how it would force the Federal Reserve to raise interest rates, this really spooked investors and the stock market. Investor sentiment, as measured by the CNN Fear and Greed Index, fell to a level of 3. This is considered extreme fear. On our quarterly market call at the end of April, I mentioned that all of our sentiment indicators were at extreme levels not seen since the low in March and April of 2020 at the COVID lows. We saw how the markets reacted, falling drastically in early April. Our Ned Davis sentiment indicator hit a level of 4, and that was even lower than the COVID low. This extreme negative sentiment was a clear sign the market was extremely oversold and ready for a bounce. I must say, I did expect a good bounce, but I did not anticipate the market going back to new highs given the current scenario of wars in the Middle East, war in Russia and Ukraine, and the much higher than anticipated tariff levels that more than anyone had anticipated. Investor sentiment, to its credit, sniffed this out and was exactly correct. Now let's look at where we are at today. As you would expect with the market at new highs, the CNN fear and greed is at 74. This is in the greed zone. We are very near the extreme greed. The American Association of Individual Investors is at a more neutral level. When we look at Ned Davis research, we see that sentiment indicator is at an overbought level with a reading of 65.5. Since 1994, whenever Ned Davis sentiment is overbought, the annualized return for the market is a negative 4.8%. Looking at the more recent data since 2004, whenever sentiment is overbought, the return is a negative 1.64%. To summarize the current investor market sentiment at this time, I would rate it at neutral to slightly negative. In the last several years, especially, investors have gotten very wise not to sell at bottoms when the economic news and geopolitical news is negative. The investor sentiment has worked extremely well over the last 5 years for sure. We just have to protect ourselves from getting too complacent. In the short term, the market is overbought, but that in itself does not mean we're ready for a major sell-off. It's really important to review all of the current indicators because we never rely on just one indicator to make our investing decisions. One of the other indicators that we follow closely that I mentioned in April that has had long-term success is looking at the 50-day moving average versus the 200-day moving average. It has had a good long-term track record at getting you in and out of the market before big drops and getting you back in before big up moves. For those listening to the call on their computers, we put up a chart. We have the data all the way back to 1929. I've updated the numbers for you tonight. Since 1929, whenever the 50-day moving average is above the 200-day moving average, the market's returned 8.99%. When the 50-day moving average is below the 200-day average, the market's returned only 0.59. Let's look at the prior bullish signal, which occurred on February the 2nd of 2023. That day, the S&P was at 4180. On April 14th of this year, we got a bearish signal. The S&P was 5406. The important point to note tonight is, as of July 1st, this indicator went back to positive again when the S&P was at 6198 on July the 1st. This indicator is now rated positive and has had a very good long-term track record. I mentioned in April that I'd like to see it turn positive and stay that way for a week or two, and this has now been accomplished. This is another sign of more clarity for us going forward at the present time. The tariff uncertainty helps to explain the reason gold and many gold stocks have been doing so well as an asset class. Gold is at $3,315 an ounce, which is near an all-time high. Gold is up 26% so far this year after being up 28% last year. As I said in April, if inflation starts to ramp higher, many analysts think gold has the potential to go as high as $5,000 an ounce. The key is, where does inflation end up and what impact tariffs have on overall inflation? Inflation may not go way up, but may stay at the higher end of the Fed's target for a longer period of time, which would be supportive of gold over the longer term. The trend for gold is clearly higher. Since April, gold has certainly become a more popular investment, and we have heard in the news that China is continuing to buy gold on a daily basis. So I would rate gold still as positive at this time. As I titled tonight's call, Is the Smoke Clearing? You can tell by my commentary that yes, we are starting to get clarity. With this clarity, we're getting more bullish on the long-term outlook for the stock market. The new tax law makes the tax rates permanent and added incentives for business, which is bullish for the markets. As we get later in the summer and approach early fall, we'll get some clarity on tariffs and, more importantly, their impact on inflation and overall consumer purchasing habits. So far, I would say tariffs have been more bark than bite. That said, it will take several months to see the full impact on the economy and inflation. We don't have total clarity yet. Inflation, although not falling dramatically, does not seem poised either to go up in a major way. This has to be rated as a potential positive for the investing markets. The biggest area where clarity is needed is the direction of where interest rates are headed. If the tariffs do not cause businesses to raise prices in a meaningful way, it would allow the Federal Reserve room to lower rates, which could very well be the next catalyst for the markets to not only extend their gains, but gather more momentum from here. That would be very bullish for investors. Importantly, the technical indicators on the market as a whole have improved substantially, including the 50-day average being over the 200-day average, which historically has been very bullish. Now, I don't want to be a Debbie Downer, but in the short term, we are overbought as measured by investor sentiment. And as a side note, in the first year of a new presidential term, August is one of the weaker months of the year. August has rarely been higher in a post-election year of a second-term president, never higher going back to Dwight D. Eisenhower. With the market short-term overbought, any weakness we experience will be looking to add some new positions to our portfolios and get closer to fully invested. We are looking to deploy more money in the market on weakness in several different areas of the market. I know I show this chart over and over, but there's a reason for this. Stocks historically have been the best long-term place to invest your money. As many of our long-term clients know, we've navigated through challenging periods. We get calls from our clients saying how happy and thankful they are having us manage their money for them and their families. We bring experience, something many money managers don't have. Most haven't been investing for as long as I have or with the same experience. Our success does not happen by luck. It happens because we're disciplined, flexible, and we think outside the box. We continue to pride ourselves as independent thinkers. Our client satisfaction is what drives our desire to succeed. As I said in April, what excites me is that, in my experience, these kinds of environments often lead to great investing opportunities, just like March of 2020. With the smoke clearing away all the negative variables, I believe our patience is going to be rewarded with higher stock prices. Of course, as any good fireman knows, we have to make sure all those little smoldering fires are out before we give the all clear. But I can tell you tonight, we are darn close. Thank you for listening, and everyone have a great rest of your summer.
Thanks for joining the call, everyone, and join us on our next update in October later this fall.